Hello everybody, we hope that you are enjoying your shortened trading week so far. My name is Tagatha and I'm here to drop in a little bit of market knowledge for you, take you through some of the highs and lows of what's been going on this week so far after June came crashing to an end last week. And I do mean crashing because a ton of US stocks had their worst first 6 months in decades. The S&P 500 had its worst first half in over 50 years, which is pretty crazy if you think about it. However, if we take a look at our weekly heat map in front of us, things are looking pretty good. Tech is up and energy is down, so there's been a bit of a reverse Uno card situation going on in the markets this week. However, if we slide down to that monthly heat map, things aren't looking quite as luscious. With any luck, we'll be able to crawl our way back into the green by the end of July. We are going to kick things off today with a bit of a currency catch-up. The euro this week hit its lowest levels against the dollar in over 20 years. It is now approaching parity with the greenback. Obviously, the world at large has been thrust into economic uncertainty, but Europe has been one of the hardest hit because of the impact on its oil and gas supplies. All comes back to Russia, which, as we all know, invaded Ukraine earlier this year, resulting in some of history's harshest sanctions being placed against Putin and his country. Russia has a dominion over the oil and gas supplies in the world, but specifically that leads straight into Europe. They've been keeping a tight hold of that in reaction to the sanctions, and Europe's economy and currency has really been struggling as a result. On the flip side, the US dollar index is at its strongest levels in 20 years, passing the $105 mark yesterday. Because the US dollar is backed by some of the largest gold reserves in the world, and its central bank, the Fed, is being one of the most hawkish globally towards inflation, people are looking at it as somewhat of a safe haven right now. They're thinking, in these times of economic uncertainty, where do I reckon I can put my money that it's going to stay safe? And this is one good option for them. As the Fed gets more and more aggressive towards hikes, we got some meetings from them yesterday, and they said the entire Fed is committed to fighting inflation, doing whatever it takes, leading us to believe that another 75 basis point hike is on the way later this month. However, good news for the dollar, because Jeffries reckons that is only going to lead the currency to become stronger and stronger and stronger as the year goes on. One thing that is not getting stronger and stronger as the year goes on, though, is Microsoft and its Activision Blizzard buy. The $69 billion deal was announced back in January, and if it goes through, it will be the biggest deal in gaming history and one of the biggest deals in tech history, probably. However, if is the operative word there, because the UK's competition watchdog, the CMA, has just launched a probe into the deal. They are worried that merging these two companies will result in lower competition in the gaming space, maybe higher pricing, maybe lower or less choice. Activision Blizzard is the parent company of Call of Duty. If you have a boyfriend or are a boy or know a boy, you will have heard of this game, and you will know it's one of the world's most popular. They also have a bunch of other popular games like Candy Crush, where my Rainbow Rapids peeps at. And regulators are worried that giving that kind of market share to Microsoft, who is already a huge tech company and has a fairly impressive market share of the gaming space already thanks to Xbox, they're worried that merging those two companies will be bad news for any other smaller companies involved in the gaming space. The UK's FTC is also taking a look at the deal, as is Australia's competition watchdog. Price-wise, both have stayed fairly stable. As you can see, Activision has been trading rather flatly since the deal was announced. Investors are probably just waiting to see if the deal is in fact going to go through. Microsoft got caught in a bit of a tech rout earlier this year, but seems to be on the rebound, and prices stayed fairly stable on news of the probe. They both say that the deal should still go ahead as planned in 2023. However, things don't always go according to plan, as the automakers of the world will tell you. Tesla this week told investors that its deliveries had dipped for the first time in over 2 years this quarter. They dipped 18%, largely because of supply constraints and a resurgence of COVID in China. China is not only the home of its Shanghai Gigafactory, which is one of its most important export hubs, but is also a really important region for Tesla. And a decline in production and sales has not been good news for them. However, other companies or other EV makers in China have also been facing these things, and they've been doing fairly well. A Warren Buffett-backed EV company called BYD surpassed Tesla in global sales this month, And earlier this year, it became the world's largest electric vehicle maker, and swiftly, but rather quietly, took that title from Elon Musk and his EV baby. So Musk better watch his back. Another up-and-coming competitor in the EV space is Ford. The previously traditional automaker has been making a massive push into EVs recently. It's been their number one priority, and it seems to be paying off. Whilst sales only grew 1.8% in the second quarter, its overall EV sales lifted over 76%, which is mad. A lot of that is because of its F-150 Lightning truck, which is now the second most popular plug-in car behind Tesla in the US. So again, Elon, watch your back, my love. Rivian, another huge competitor in the EV space, this week gave investors a bit of good news. They said that they are on track to hit their 2022 production target. On the one hand, that production target is half of the amount they promised investors in their IPO roadshow last year. They sliced their target down to 25,000 in March this year because of supply constraints. But on the other hand, at least it's on track to actually meet that target. It's instilled a huge production ramp up in its company in the last couple of months. It's delivered just under 4,500 vehicles and produced, again, just under 4.5 vehicles this quarter. Shares had a little jump for joy, up 10% on Wednesday. So definitely a good company to keep an eye on if it manages to keep its promise to investors. If not, you never know what could happen. However, you can keep up with all of this and more on our Snaps page. We also send a daily email that's in your inbox by 9 a.m. And until next week, stay safe out there, everybody.